In this video, we will try to get an overview of the exchange control law in India. How exactly does India regulate foreign investment? And what do you need to know before you commit capital? The central government sets the rules of the game, deciding in which sectors and how much foreign investment is permitted. The Reserve Bank of India then writes the playbook. So, understanding sector-specific restrictions is crucial before committing capital. Not everyone can invest in everything, and every sector is not equally open to everyone. Hello and welcome back to the Veyrah Law series. As a foreign investor interested in the Indian market, it may be interesting for you to know that India still has capital controls in place for money coming in and going out of India. In this video, we will try to get an overview of the exchange control law in India. For those of you who are new to our video series, my name is Ajay Joseph. I'm a partner at Veyrah Law. We're a law firm based in Mumbai, India. You can find more information about us on our website. The link is in the description below. As usual, before we get started, a quick reminder. These videos are not advertisements or solicitations. They are only for sharing knowledge and information. Nothing here should be treated as legal advice. Please do consult your own advisors before making any decisions. And again, read the disclaimers carefully. With that said, let's get right into today's topic. If you are a foreign investor or a business looking at India, the big question is, how exactly does India regulate foreign investment? And what do you need to know before you commit capital? Let's see how the system works, how it evolved, and why it matters for your investment decisions. All cross-border transactions in India are governed by the Foreign Exchange Management Act 1999, or as we lawyers fondly call it, FEMA. FEMA is the backbone of India's foreign exchange regime. It distinguishes between two main types of transactions: capital account transactions and current account transactions. Capital account transactions involve any changes in financial assets or liabilities. For example, acquiring shares, buying property, or giving loans. They are subject to regulatory controls and must follow specific FEMA regulations. Current account transactions, on the other hand, these are day-to-day trade and service payments. For example, imports, interest on loans, consultancy fees, or even paying for education abroad. These are generally free unless specifically restricted by the government or Reserve Bank of India. The general thumb rule being all capital account transactions are prohibited unless a specific law or a rule grants permission for the specific type of capital account transaction. All current account transactions are freely permitted unless a specific type of a transaction is restricted under a rule or regulation. This is the foundation of how India broadly regulates money moving in and out of the country. But let's take a quick step back to understand the evolution of this present-day system. Before FEMA, India had the Foreign Exchange Regulation Act 1973, as it was then called FERA. The FERA was a product of its time, a different era, a closed economy, strict controls, and even criminal action for violations. With the economic liberalization in the 1990s, FERA was replaced by FEMA in 1999. FEMA distinguished itself from its predecessor by being more liberal and designed to facilitate trade and investment, with violations considered less harshly, with negligible criminal implications. This change in a critical law also marked India's shift towards a more open, investor-friendly market. Relatively speaking, of course. But we'll soon see why FEMA still retains some of the legacy thinking. Nothing sums up the exchange control story better than the saying, history never really says goodbye. History says, see you later. Under FEMA, not everyone can invest in everything, and every sector is not equally open to everyone. Cryptic, right? Let's dig a bit deeper. There are different investment routes depending on the type of foreign investor. Now, before I go further into this topic, I'd like to sound off that these are general principles, and as with everything, there are exceptions to the norm. That said, let's understand how the broad principles operate. Generally speaking, most foreign businesses and foreign nationals who reside outside India can invest across the spectrum in India. It's open to nationals of all countries, barring some specific ones from the Indian subcontinent and neighboring countries. Generally, foreign businesses and foreign nationals are allowed to invest in unlisted and listed equity. They can also extend loans to Indian companies in the INR currency and in Forex. The second category is Indians residing outside India, or as we call them, NRIs. And then there are foreign citizens of Indian origin. This is a special category and they have added advantages. Then comes another category of foreign businesses and entities and foreign nationals who have to get a specific registration with the financial market regulator SEBI, and that's being registered as a foreign portfolio investor. This essentially allows them to buy and sell securities on the Indian stock exchanges. They can also invest in certain other securities like units of mutual funds, real estate investment trusts. These are all permitted under this category of investors. There's another category which is called as the foreign venture capital investor. This also requires a registration with the financial services regulator SEBI, and it offers certain added benefits and relaxations as compared to the other categories. But the only catch is that the FVCI has to invest most of its committed funds in unlisted companies. Each of the categories of investors can invest in equity or debt instruments, some having more options than others. So while there are multiple entry points for foreign investors, each has its own compliance framework. Also, like I mentioned earlier, who you are matters, and how and where you can invest is a function of who you are. Let's understand this in slight detail, specifically with respect to the foreign direct investment regime. This is what is most relevant for a typical foreign business looking to enter the Indian market to set up a base. There are multiple categories in which the foreign direct investment regime operates. The first is whether the investment is under the automatic route, when no approval from the government is required, or the government route, where you need a prior approval from the government before you can make an investment. Then there are sectoral caps, which defines the maximum amount of foreign ownership that is allowed in a particular business sector. There are some sectors which are under the 100% automatic route and some where conditions apply. For example, as of today, telecom has 100% foreign direct investment allowed under the automatic route. But in defense, up to 74% is only allowed under the automatic route. Anything beyond that requires approval from the government. On the other hand, 100% of foreign investment is allowed in manufacturing. You have media and news. In these cases, restrictions and caps apply, and with many other subsectors requiring approval from the government. But if you were to do a real estate project in the construction development of townships, you can have 100% investment by foreign investors, but it comes with certain conditions. So, understanding sector-specific restrictions is crucial before committing capital. But as we discussed in our earlier episode, India has a complex regulatory system. While FEMA is the applicable law, different authorities regulate different things. Let's see who regulates what. While multiple institutions are involved, from the central government, you have the Department for Promotion of Industry and Internal Trade under the Ministry of Commerce. You also have the Department of Economic Affairs under the Ministry of Finance. These two organs of the government frame laws and policies with respect to certain matters under FEMA. The Reserve Bank of India manages day-to-day compliance and regulations under FEMA. Then you have sector-specific regulators like IRDI, SEBI, the Reserve Bank of India. Think of it this way. The central government sets the rules of the game, deciding in which sectors and how much foreign investment is permitted. The Reserve Bank of India then writes the playbook, detailing how the money flows, how it is reported, and how compliance is ensured. The regulators step in to provide approvals where required. As an investor, you will often find yourself navigating across these government authorities. But why would this matter to you? As the saying goes, the essence of strategy is choosing what not to do. The broad frameworks will really determine how you invest into India, how you structure your deals. You'll need to decide whether approvals are required or not. Which sector is your business in, and is it open to 100% investment or does it have conditions? What commercial operations would you decide not to undertake in order to avoid regulatory approvals? For example, if you were to do a real estate project in the construction development space, it's 100% under the automatic route, with 100% investment by foreign investors. But it comes with certain conditions. The Indian investee company, which is the company in which you invest, is allowed to sell only developed plots. There is a 3-year lock-in period for construction development projects, which means you cannot exit before 3 years. The project has to conform to land use requirements and provide for all common facilities before any sale can take place. In the industrial parks section, if the project is an industrial park, it needs to meet minimum unit requirements and minimum area utilization norms. But if you were to engage in the e-commerce space, you are allowed to operate purely as a marketplace model only, without taking any inventory, and you can operate without any approval from any specific regulator. Of course, general business approvals under state and central laws will continue to apply to all other businesses. A well-planned entry with the right structuring and regulatory compliance can save significant time and resources. So there you have a high-level overview of India's FDI policies. In future episodes, we will look more closely at specific sectors and share practical structuring strategies. If you have any questions with respect to this episode, please do drop it in the comments or send us an email. Someone from the team will surely respond. And as always, if you found this video useful or think it may be useful to others, please do share it. Until the next video, have a wonderful day.